Hello and welcome to Stock and Roll, the podcast where we deep dive into the world of equity compensation. Today we're turning our attention to, in my mind, one of the most complex corners of equity, private equity incentive programs. I'm joined by Sonia Gilbert, partner at Clifford, who advise on all things remuneration related, with a particular focus on management incentivization in private equity-backed companies. In this episode, we explore what makes PE programs different from listed or from startup plans, and then who actually participates in a private equity-backed company and why this is starting to change. We also discuss the enormous challenge of communicating value when there's no updated share price, how companies handle liquidity as business stay private longer than ever, and also the tax-driven structures that make real ownership such a priority. Let's dive in. Super to be here with you, Sonia. This is another episode of the Stock and Roll podcast. This time we will cover private equity programs. It's a topic that I've been very curious about. But first, give a short intro of yourself.
Thanks. And I'm really pleased we're here talking about this topic because I think it can be one that can be a little bit mysterious to people. I'm Sonia Gilbert. I'm a partner at Clifford and I spend my days looking at all things remuneration related. And a big part of what I get involved in is private equity and management incentivization. And we're going to talk about today, I know, what it looks like for senior people, but also what it looks like when it's broader. And I'm really keen to get into both.
Absolutely. Super. Of course, you have base salary and you have a bonus, and then you have share-based payment. You have pensions as well, but share-based payment. And we've in this podcast covered more listed or VC-backed startup type of programs. If we start very broad and thinking, what is different here in the private equity world, very high level first?
Yeah, sure. I think actually a lot of what you've described in terms of how someone's package is made up isn't that different. The big difference is, are you getting something like an LTIP, say, in the listed company environment, or management equity in some form in the private, PE-backed space? And I think the big difference there is probably mainly a couple of things. One is trying to make sure that people are genuine owners of the business when the business is private equity backed. So they are really sitting alongside that private equity investor. They are maybe feeling the pain at times the same way that the investor might, but also feeling the upside. And then I think it's often the tax drivers too, and looking to give people something tax efficient, but in a private company context.
Do you think that tax is a bigger driver in designing programs in private equity if you compare it with an early stage company or in a listed company? Is it more important? Always a bit important, but yeah.
I think it probably is more important. I don't say that it is the key driver of how these things are structured, because I think a lot more of that has to do with the hearts and minds and the economics and the things that we just talked about. But I think, at least to date, tax has been a key driver for many jurisdictions in which these businesses might sit. And we'll get into it, I'm sure, but as there are jurisdictions where the difference between your capital tax and your income tax and the rates gets narrower, there may be less of a drive to structure things in particular ways for tax reasons, but appreciate we're not there yet.
No, definitely. I think just reflection on that is the way I sometimes see it is that you, of course, in the startup scheme, you have very often qualified option rules in most jurisdictions, and then it goes a bit without saying almost that you will end up there because it's so more favorable. And you can say it's of course tax right, but it's just the way it is, you do it. So it's quite straightforward in many ways. But in the listed, of course, here you're also lucky to have fees and kind of schemes here, but in many other jurisdictions where you don't really have so many solutions that are tax beneficial, you end up more like with a bit of discounted shares or something like that. But in private equity, you tend to go a bit more exotic every now and then, and you can do a bit more different things, right? If we then think who receives equity in the private equity programs, is it broader, smaller? Are there any trends, anything you see there?
Yeah, that's a really interesting topic because I think that is one where you see things change over time. So as long as I've been doing this job, it's always been used for very senior management. And that makes sense. You might have a management team that's been with the business a long time, or a new management team that the PE house is bringing in over time, and you need to incentivize them. And they are clearly going to be some of your key people for getting towards an exit, which, at least in the pure private equity environment, is always the aim of the game. A little bit different when you get into things like infrastructure funds where they might be holding for longer term. But if we think of pure PE, always senior management. And then I think what has differed, in part, it's over time and trends in the market, in part it probably depends on the business, is how broad do you go with that? And if you think of things like KKR and what they have been coming out with, and some of the drives towards broader employee share ownership in the PE-backed companies, I think we have seen more PE houses, together with management, think, is it right to give people something? Might not always be the same as at the very senior end, but give people something. A lot of what we're thinking about day to day is very global, but thinking about it from a pure UK perspective, where we've seen, for example, say big listed supermarkets or retailers that have been taken into private hands by PE, that will have been probably a situation where people were used to things like SAYE, used to broad-based plans. You can't have them in the private equity environment. They don't work with our tax rules, and they haven't done. And people have campaigned long and hard to try and make that work. So sometimes there are reasons like that why people think, okay, people had that before they were in private ownership. Now we need to give them something else.
Yeah, and I think it's also a bit like in private ownership, especially when it's private equity companies, it is basically very often one or two owners, and then it's easier to align the packages also with the owners, because if it's in a listed side or in a typically VC-backed company with many rounds and there's kind of multiple owners, some owners may want to exit earlier, some want to exit later, but in the private equity it's a time horizon which is a bit easier, it's still difficult to design a good program, but it may be easier to at least align with that incentive that the private equity have.
Yeah, completely agree.
Yeah. And in terms of the people involved, are there any reasons for not going broader?
I think it's a very, very fair question, as I think some of the reasons make sense. Some of them I think are sometimes just more of an emotional feel of management should be in the equity and maybe other people shouldn't. I think part of it comes down to communication, because a lot of these arrangements are harder to communicate. They're not as easy to explain what it is you've got. And anecdotally, I know of management who are super bright, very entrepreneurial people who are running brilliant businesses who say, I didn't quite understand what this MIP was. So if it's hard to understand at that level, and you might be looking at people who may not have had shares before or not shares in this context, it can be hard to communicate. I think the other thing is a lot of these plans involve people putting in real money. So you've got money at risk. And so I think sometimes when people are thinking, oh, should we go broader? We say to them, well, don't necessarily think that it has to be the same for a broad-based plan as at management. And so you may get a tiered approach and have real equity at the most senior levels, maybe equity, but with slightly different terms in the middle, and then have something broader based, which might be shares, it might be cash, it might be options, something else, if you go really broad.
Yeah. And I guess also, even though you want to like broader programs and think it's a good thing, I think eventually it also needs to be something that the private equity or the owner thinks that they give away one and they get more than one. Because it's like they can't give away just because it's a nice thing and others do it and it's a trend, right? You need to think that it creates more motivation and it creates more engagement and then hence performance and shareholder value, right?
I completely agree. I think there's also always the question of, if I'm in a plan, when can I get my money out, or when am I going to get value?
Yeah.
And clearly, if you're comparing it to the listed company environment where there's a ready market, you haven't got that in the PE-backed company. So you are saying to anyone who's in these plans, look, we need you to stick with this until we get to an exit. And hopefully that will be 3 to 5 years.
Yeah.
But we've obviously seen a lot of businesses that have been held a lot longer. That can be a more difficult sell to employees.
Definitely. And then even if you add what you just said in terms of like you invest your own money in, but you have no idea when you will get it back, right? Or
exactly.
It's very hard. So definitely that part is also super, So if we go a bit more into this ownership works and KKR and the broader range of people, is it something you see here as well? Or is it still something you hear about? Is it questions you get often?
Questions we get often. And then I think when we explain the pros and cons of doing it, we have some people who say, no, this isn't the right approach for us, and others who will go for it.
Yeah.
If I think about things that we've seen where people have gone ahead, it's been interesting that they have chosen a real range of different plans to suit their businesses. Some have said, actually, given all we've heard, we're going to stick with cash.
Yeah.
We're just going to give people something on an exit, but we'll go broad. And others have involved real equity, whether that's something that people have bought into, maybe with a match, all sorts of different structures. But I think there are still instances where people look at it and say, no, this is too difficult and maybe it's not right for the business. Where the business has been something that has maybe been in the listed world, been taken private, and people are really used to having SAYE, SIP, other types of broad-based plan, then I think there's often more clamour from employees to say, okay, what are you giving us now?
Yeah, no, definitely, that's a good point. And also, if you go broader, do you see then that you typically copy more the model you have on the top executives, or do you see more of free shares, RSUs, simpler, more plain models there?
More simpler plain models.
Yeah.
Don't get me wrong, we've worked with some businesses where they've said everybody needs to be in the same kind of MIP, and they've gone down quite deep within the organisation. But on the whole, where people go broader, they choose to have a different structure for, particularly when they're going to lots of employees. We've worked with a company that's probably gone to around 1,000 employees globally, and they have this tiered approach I mentioned of real equity, putting your hand in your pocket, and then real equity, maybe not with an investment, and then something cash-based or free shares below that.
Yeah, no, makes sense. And do you see any differences? I know you're a bit involved both internationally and in the UK. Are UK ahead of the curve, behind the curve, if you compare it with other places, or is that hard to see a trend on that in terms of going broader?
I think it's a lot less driven by jurisdiction and a lot more driven by what's the nature of the business and what have they had. So a business that we worked with, which had some people in the UK, but actually employees in probably about 20 different jurisdictions, they said, we management feel really strongly that everybody or most people should have something, because that's what people are used to.
Yeah.
And then it was a question of how do you make it work in all those places?
Yeah, okay, yeah, no, definitely a good point. Just a bit upon it as well in terms of value, liquidity. So a private equity investment, you do an investment, you have a value at time zero. Very often from that point of time, almost to an exit, you don't have a value. Obviously, there are some internal valuations for the private equity, but that may not necessarily reflect the market. So how do you look at the communication of value? How do companies do that? Are there any do's and don'ts? Just open. I find this very challenging. Yeah.
That's exactly the word I was going to use. I think it's a real challenge because I can see from the private equity investors' perspective, they're looking at it and thinking, okay, well, we know what it's worth. We've got our internal valuations as we go along. Let's assume that the business goes in the right direction and you're heading towards a successful exit.
Yeah.
For quite a long time, once the investment's happened, the business may be at virtually the same value before you hope that it starts almost like a hockey stick going up a lot towards the point of exit. And so it's, even if you do communicate it, quite a difficult message to say to employees, maybe there's no growth here.
No.
Maybe you've actually invested and there's still no growth here. So I think doing the valuations is a challenge because it's time and cost, and it's how do you communicate it. But equally, it may not necessarily be a good news story if you're giving people frequent updates, which I think is partly why you tend to see people being told, we'll let you know closer to the point of exit what this is going to be worth, or, which is a fair point, we won't know what it's worth until we get to the point of exit, because it's all down to what's someone prepared to pay, or if we're selling, or if it's an IPO, what will the market price us at?
Yeah.
So it is a much more difficult communications exercise, I think, and sales point for employees in a listed company.
Yeah, definitely. Do you see someone trying to give and to kind of update and using some sort of internal valuation mechanisms with all sorts of disclaimers? Or do you see that most just say, we don't communicate value until an exit?
Very rarely have I seen people do communications internally. I think where I have seen it done has tended to be where maybe it has taken a bit longer to get to exit than had originally been planned. And you may be resetting your management equity plan, doing a Mark II of it. And at that point in time, you're having to explain to people what's happened.
I think this point is super interesting, and I understand it's very complex. But if it's a company that are well within rule of 40 when they're required and profitable, great. And then you come in as an investor, obviously, you know, you have a 5-6 year horizon on things, and you spend a lot of money into it, and you go way out of rule of 40 for quite a long time, right? And growth may take some time. So how do you get people to understand that journey? And especially if you go broader. And I think then it's very easy to say, communicate the value. But you need quite a lot of insights to be able to understand where you are on that journey. So I think it's, And do you see that, or how do you think this reflects and impacts the value of the equity? Because one thing is the share what it ends up being when it's an exit, then it's easy to say what it's worth. But do you feel that participants in the programs have less interest, put less value, perceived value versus cash or bonus or other things? Is it more challenging here than in other roles?
I think overall more challenging at the senior management level.
Yeah.
As long as people understand what they're in, and given that they will be the people who are seeing a lot of the internal valuations and they know how the business is going,
Yeah.
I think hopefully they recognise the value or not and what may need to bring it back into the money of their plan. But I think for the broader based plans, it is much harder.
Yeah.
And I think people who get the best out of those type of plans are able to explain to people, look, we all need to try and drive the growth of the business, get to a successful exit.
Yeah.
This is the time horizon roughly that we're looking at, and we'll really appreciate your support with getting there. Once we get much closer to the time, we'll have a better idea of what it's worth.
Yeah. And then one layer deeper in the challenging part of communicating it, you have hurdles and you have preferences and so as well. So not to get too detailed on it, but how do companies communicate that? And why I'm asking is that, let's say it's a broader plan and you may think you get a payout because of the company has been growing okay, but not to really let the waterfall give something to you, right? Have you experienced that could be a challenging one to communicate and too disappointing at the end?
Yes, on occasion, but I think this is really why lots of companies, so for the broader based plan, will have something that may not necessarily be coming out in this way via the waterfall, something paid for that is separate, because then we know that it should have some value in it, and it's much easier to communicate. But even for the more senior plans, giving people clear communication up front about how it works really means, I think, is really key, because otherwise you're looking at it thinking, great, I think what I've got is in the money, and you might find that it's not at all.
Definitely. I think first understanding the value, is it anything you can't communicate? Most likely no. And then communicate that you can't, at least, so that you're very upfront about what you will get and what you will see.
Yeah, I agree.
And then simplifying things as much as you can on the broader range if you want to include more people doing free shares or simple investments that kind of are not too far down in the waterfall priority side.
And as a matter of interest, with your clients that are private equity backed, do you tend to see them communicate much on the value side?
Sometimes this is where I started to be a bit frustrated, right? Because you're very used to working with listed companies for a long time, where communication and transparency and these things are super, super important. I've also seen it in the private companies where you've done raises on not private equity, but like you've raised a lot of money on a high value, right? And then the value goes down. How do you keep motivation? How transparent are you on these things? Because here as well, there's suddenly a preference that takes everything and you don't really know that, right? You need to at least start communicating. But then in the private equity, it gets even harder. So how we've seen things here in the clients that we've been working with is a bit aligned with what you say. There's an MIP for the top 15, 20, 50 people, depending on the size. But we've seen more and more of the ones that go broader. But there you buy shares at market price and you're allowed to invest into it. And that's just a nice thing, how they communicate it. And then you have to just be a part of how it goes, and one share is one share, and as you say, kind of kept a bit on the side. You could be a separate share class, which is a bit simpler to work with. But we've also seen some RSU plans, so basically saying that they don't want you to invest money, but you will get free shares in 3 years from now, as an example. Of course, tax not beneficial, but still you will anyhow be taxed income for your bonuses, so they compare it more with that, and it will be dependent on the company's success, and it's very easy to understand. So a few of those, but I still think it's work to be done in that area in terms of, is it anything you can do to make some sort of a model or something where you can do communication a bit simpler with, of course, a lot of disclaimers, but get a bit closer to following how it goes. But again, I think it's super interesting, and I think it's exciting to see where we will be in 5 years, where we will be in 10 years. And if it gets more and more common with broader plans, I think you will need to see something more and more similar to what you see in the listed world. And to my next question as well, and the pivot there, when companies remain private longer, then you need to find some liquidity, or you need to do something with the programs. And the listed is easy. You could sell shares when they're vested and then cover your taxes and buy yourself a trampoline TV or a cabin. It's that much, right? But to that point, liquidity and timing, do you see the lack of listings, companies remaining private longer? Do you see that as something that is addressed in the design?
I think it probably depends on whether you know up front that it's going to be a long-term hold investment. Because if it's an infrastructure fund backed to investment, something like that, it will be longer term. You may know it's going to be more like 7 to 10 years. And so probably when you're designing the plan, you're already having to contemplate, are we going to have some kind of liquidity window, probably an internal market that gets created, not to give full value, but to at least allow people to get some value before the 10 years in my example. Whereas I think with the traditional private equity backed companies, where people are still looking at more like 3 to 5 years for exit, if it takes a little bit longer, it might be a case of less giving people liquidity and more thinking about, is there a top-up incentive that we need to offer to persuade people to stick with us for that extra period to get to sale or IPO or whatever the event is.
And if they open up to some sort of liquidity on the 7-10 year plan type of thing, how do they value that? Do they actually get an external buyer in and then it's basically market setup, or have they agreed on some sort of like a multiple or a EBIT multiple or growth/revenue multiple or something in advance, or how do they price it?
Where we've seen it done, companies have tended to have an external valuation done on the shares. That's in part because if they've done it that way and if they've had it done for tax reasons, you also know that it's going to give you the tax outcome you anticipate. And then in terms of how it's structured, we've seen a couple of things in practice. One is almost matching buyers and sellers from amongst your employee community. You don't always get a neat outcome, of course, but at least it's that opportunity, and depends on whether people want to get out earlier, want to realise value, versus other people who might look at it and think, I think this is a good price to buy out. I'm in here for the long term. I'm taking a positive view of the bit we're going to get to exit and I can create more value. So we've seen that kind of matched buyers and sellers. And then the other thing that we've seen is using some kind of internal pooling vehicle. Employee benefit trust is a common one, where that trust is used to recycle the share. The question is always on those models, where's the money going to come from? Because clearly your buyer is an entity that doesn't have funding. So you're really looking at the company or back to the investor for that.
Yeah. And if the company thought they were going to IPO 5 years from when they invested, and suddenly 7 years have passed, and it's hard to say when the IPO will come or exit in any sense. Do you ever get pulled back in then to say, okay, we need to do something here? Or are they fine with, okay, what we thought were 5 years will be 10 years and there won't be an exit? Or do you kind of do some modifications on the program due to this?
Probably depends on the circumstance, in all honesty, because I think some companies are looking at it and thinking, what does our employee and management base look like? Are we losing people? Are we partly losing people because we're not getting to an exit that we said that we were going to get to in this time horizon? And so I think people are looking at it thinking, what do we need to do to make sure that we can keep the good people that we've got and maybe get in some additional people who are going to help drive us to get to that point of exit? And so I think we see people looking at top-up incentives, modifying the plan, sometimes completely modifying the plan and almost resetting it with different hurdles, different parameters, and something that's really meant to drive performance. Yeah,
so you can see that it didn't really fit the purpose, so you need to change based on some sort of fair market value on what's at that point of time, and then you need to have them accepting a new agreement. On the structures, one of the things that I think complicates it a bit as well is that you don't necessarily own stock shares directly into the company that you work with. It's maybe some vehicles, SPVs, or pooling mechanisms here. First of all, why do companies do that? Can you avoid doing that if you want to? And how does that complicate the perceived value, the way you think it?
Yeah, I think it's a good question. Short answer is, in most countries, yes, you could have many, many shareholders on your register if you want. You could have people hold directly. I think some places there's a limit on the number of people you can have. So that will by itself mean you're probably looking at a pooling vehicle. But even where that doesn't apply, it keeps your share register nice and clean. If you're using a pooling vehicle, it makes exit in theory a lot more straightforward, because you've only got that one shareholder that's the pooling vehicle to agree to things, and then all your documentation and what you've agreed with people behind the scenes is what governs what happens to their shares. And it does mean also that in jurisdictions, and the UK would be one of them, where your shareholder register's public, you've only got that one pooling vehicle showing, and it doesn't say, you know, Tom's got 5 and Sarah's got 20, which people can see. So I think from an employee fairness, confidentiality perspective, it can also be useful too. But I think it's really important to explain to people what this thing is, what they've signed up to, what it means, so that they understand I'm not a direct shareholder, but ultimately I'm getting the same economic benefits as if I sat on that register, and there's some very good reasons for me not to be. So I think that's what it comes down to.
Do employees feel that they are shareholders, or does it get closer to a synthetic plan in terms of perception?
I think in some companies at the very senior level, we see that the most senior management are always direct holders.
Yeah.
And I think that is so that they feel a genuine shareholder and aligned. Below that, I'm not sure that it makes too much difference to people whether they hold shares directly or not. Because often the company that they're holding shares in is, Topco ABCD Limited. That is not the employing company anyway. And a lot more of it is about communicating what it is you're doing and getting rather than the legal structure.
Yeah, I think that's like you need one legal chart and you need one, a bit in layman terms, what happens if X, Y, Z, right? And don't forget about that side. Bit on tax as well. So generally, everyone seeks to get within fairness as low tax as possible. And it's very often discussed capital gains tax versus income tax. What is the most common way of getting to capital gains tax in the private equity world, the way you see it?
Short answer is people hold real shares.
Yeah.
Often real shares that they've bought and bought at whatever they were worth at the beginning.
Yeah.
Sometimes they may have had funding given to them to do that, but they still bought them.
Yeah.
Or if they're not buying them, and this is a bit more unusual, at least they've paid tax on everything up front. So any growth is capital rather than income. That's what people are looking to achieve.
Yeah. And there's often this funding/loan opportunity, or not often, but it is more often here than other places that you get a bit of, when you reinvest, you get some sort of, you could call it a matching or some sort of a loan or something, so that you get a higher exposure potentially than what you have in clean cash. Do you see that in the private equity side often?
Actually, more often people being loaned the funds to put into the investment in the first place.
Yeah.
So it's not necessarily giving them that matching effect.
Yeah.
But it may be that they have only had to fund a proportion from their own funds, or maybe nothing at all.
Yeah.
And then that loan would unwind at the point of exit when you hope you've got enough, more than enough value.
Yeah. Here we've seen a few of these, like how much can you give and loan, and how much kind of, let's say that everything goes belly up, how much do you have to repay?
Yes.
And that kind of balance in terms of knowing that risk versus you still want to get into the income, not to the capital gain tax world.
Yep.
But then also you are liable for what's there. So we've seen a few of those. So RSUs and performance shares and more kind of promises of something that can become something hasn't been that common. Why is it not that common? Tax may be one of the answers, but is it more? And two, are there any changes in ESG targets like performance shares? Do you see that in the private equity world at all?
So I think in terms of why they tend not to be used that much, it probably comes down to what we were talking about at the beginning.
Yeah.
The sense of making people real owners of the business, coupled with tax. So I think that's what tends to drive more plans that involve real shares, certainly at the senior levels.
Yeah.
Below that, there's definitely a mix of things. So it might be, to your point, RSUs.
Yeah.
It might be a stock option with some kind of performance conditions or KPIs. It might be an exit bonus type plan, all of which probably going to end up getting taxed as income anyway.
Yeah.
And then it's a case of, well, what KPIs do we need to drive the right business performance? What I don't think we see so much in the private equity world is what you see in the listed company environment, where it becomes a trend or it becomes market or investor expectations to have certain types of performance condition attached to whatever you've delivered. And so in the way that we've seen a lot of listed companies have ESG targets as part of their performance, almost as a matter of course, you don't see as much of that in the private equity world, unless it happens to be the kind of company where that really makes sense because of the type of business. So I think that the performance measures we see tend to be a bit more bespoke in the private equity world.
Yeah. Are they individually, or are they based on a company or kind of entity? What sort of performance metrics do they use, if they use anything?
Where they do use them, they tend to be more company-based.
Yeah.
And I think that's partly because you've often got the senior management with the real equity MIP, as we've been discussing.
Yeah.
And then that will be based on whole group performance. And so you want probably something at whole group performance. Sometimes it's business unit, but more often group when you get down to broader levels.
Yeah, cool. We're getting closer to the end, but if, let's say you were in a situation where you were private equity, you know everything you know now, and you had all the money, so you're the only owner. It's a 1,000 people company.
Yep.
Within construction.
Okay.
And there's a management group of 7 people, but there's also a broader group of 50 top execs.
Okay.
How would you go about it if you were to decide everything with no more info than that? So it's a very hard setup, but how many would you include? What sort of mechanisms would you do? Very high level.
I like this question. It's the kind of question that we get asked. This is good, but I haven't had quite this one before.
Yeah.
So I would definitely have my top 7 holding real equity through a MIP. I think key would be that they've put money in, whether their own fund or loaned. They know they've got that skin in the game alongside me as the private equity investor.
Yeah.
And I would spend a lot of time making sure that they understand what they've got. Because frankly, if they don't, these incentives are valueless.
Yeah.
Why have them?
You give cash instead.
So so that's what I would do for that. For the next 50 in your example, I would give them something, but I wouldn't put them in that MIP.
Yeah.
I would probably put them in something that was equity related, because I think giving them that real sense of this is linked to the value of the equity in the same way as management is not only good for me as the private equity investor, but is a much easier sell for management explaining it to those other people.
Yeah.
So that's what I'd do.
Yeah. And you would not go to the 1,000.
I'd give the 1,000 an exit bonus, a pool, so that everybody gets something as a result of the transaction. Because in the kind of business you've just described, the reality is that everybody is going to be key to getting to a successful exit to a greater or lesser extent. So I would really like to be able to incentivize that broader base, particularly if they've been in listed company environments where they're used to having something.
Yeah, definitely. No, great. Sometimes we get asked the question, so what would you do? And
well, I was going to ask you, what would you do?
Yeah, I think something quite similar. I think it's important with these 50, because it's like what you said, you have the executive top 5-7. It's very hard for the top 5-7 if that's not aligned with the 50, right? How to make sure that you can really drive towards what create that value if you don't have that broader group with you. I think that part is important, but I fully agree with you that it needs to be easy and understandable. So it would, depending a bit on how easy it will be to get that group of people to understand what it is. And I would have spent a lot of time, as I say, on these people to really understand and to get them on. I think also I would have done something with everyone, but I think it's a bit of, here you need also to be a bit like, you're investing others' money. So in this case, you decide everything, but very often it may be that some of the money you have raised.
Yep.
And then it's very important that you think what you give to everyone else, that you really look at that versus what you think you will get back, right? Because churn, of course, you don't want churn on people, but some are also replaceable. And it's a bit of a tough and harder approach to it. But I think finding that balance there of really giving something that motivates, and you need to feel that this motivates and this makes performance better. I think I would have really stress tested that on the broader group to that there's something that gives something back. Of course, it's always nice to close the pension gap and work with that, but you also need to justify it.
Yeah, completely agree.
And I think communication of it, regardless, really go through, work with some agency or have, it's a video, all staff meetings, do something, do a lot based on that, because I think it's very often overlooked and it may end up, you spend a lot of shares and potential upside, and if 60, 70, 80% of the people don't understand it, you should have dropped it, right? Yeah.
Completely agree.
Yeah. Great, that was it. Thanks a lot, Sonia. It was a pleasure talking to you, and we can do a more tax deep dive or a terms and condition deep dive later. Yeah.
Thank you.
Good. Thanks.
Bye.
Bye-bye.